Hello and welcome to this week's edition of Retire Well, brought to you by the team of Citizen Advisory Group. I'm your host, Kristen Oakley, and joining me in the studio is owner and financial advisor, Kevin Bucher. We're so glad you're joining us today. Today's title is called Navigating the Storm of Market Downturns. We're going to be tackling this subject, which often strikes fear into the heart of a lot of retirees and those of you that are planning to go ahead and retire sooner rather than later. So we're going to unpack all of that today. We're going to look at what history tells us about market downturns. We're going to look at why trying to time the market does not work, and then also offer some practical strategies to help you successfully navigate turbulent times. Kevin, my friend, a lot to unpack today. Excited to be here with you as I always am.
Yeah, what a great topic for us to talk about today is when markets don't perform well.
Yes.
I think we all know that it's an unfortunate part of investing that we're going to go through some down periods, but hopefully we can make this a little bit lighthearted and fun today, and at the very least we're both wearing some bright colors, so we'll brighten some of the bad news.
Exactly. We're going to make it, the not so good news, make it as good as it possibly can be, right?
Yeah. Maybe just put everyone's minds at ease a little bit.
Yes.
Because as we go through this, I think we'll uncover that this is, downturns are to be expected. They're a normal part of market cycles, and they happen on a very regular basis. So hopefully we'll make everyone feel just a little bit better today.
Well, and to your point, this is something that happens. It happens regularly. The markets only do one of two things. They go up and they go down. We can't control when those downturns are going to happen, though. So we need to be prepared for them. And I think 2025 has shown us that there's some volatility in the works. And I know you've had a lot of conversations with folks about that. So that's why we wanted to devote today's conversation to it.
Yeah, and I think part of the confusion around this comes with there's all these different terms that are thrown out. There's downturns, there's drawdown, there's correction, there's a bear market. Yeah. So what do all these things mean?
Yes.
It's basically talking about the same thing. Market values have dropped. So when you hear the term a correction, that is when markets have fallen 10%.
Okay.
And then a bear market, which is certainly a little worse than a correction, is when markets have fallen 20% or more.
And they're down for a longer period of time.
Yes.
Right.
Yeah. So bottom line, though, is this is a normal part of the investment cycle. We typically see a correction pretty much one time per year. So I know every time we go through these market downturns, it feels like, oh, this is the end is coming. This one's different than the last one. But a correction happens about once every year. And then a bear market, I think this is surprising to a lot of people. A bear market happens once about every 3 years on average.
Yep. And so those percentages, though, even though this is common and it happens pretty frequently, 10%, 20%, I'm sure some of our viewers listening to that are going, I don't like the sound of that at all, right? So that's the challenge, is how do we navigate through those, especially when you've worked so hard to save. You don't want to have your money at risk to lose 10%, 20%, right?
Yeah, it almost makes you feel like, well, if this happens every year or every 3 years on average, well, why are we investing and taking this risk? You know, and it's because markets generally recover.
Yes, so we got to talk about that. How often do they recover from these downturns?
Yeah, so and we're going to reference a few different research studies that have been done. So I don't think this one required a whole lot of research, but Ibbenson and Associates, which is now a part of Morningstar, they looked at historical market performance going back to 1926. Okay. And I don't think this will be a surprise to anybody, but when we go through these corrections and bear markets, markets have recovered 100% of the time. So pretty good odds that the markets are going to recover from these corrections or bear markets that we might be going through.
Right. And so that's the key, right, is that we know that historically, long-term, over periods of time, the stock market has never lost money. However, that doesn't always make you feel good when you're approaching, nearing, and entering retirement and you no longer have a huge time horizon on your side. That's the key difference, right?
Yes, so there has to be some shift as we go through the different phases of our financial life, and we are absolutely going to get to some of the strategies and solutions on how to protect yourself. But I think at this point of the show, I really just want to focus on that this is normal when we see periods of volatility and we see the markets drop. And so when you look at, it's a little more data from that research, over 1 year periods, the overall market as measured by the S&P 500 posts positive returns 75% of the time. So when they did this research, they basically looked at the rolling periods, rolling 1 year periods. So it wasn't January to January, it was January 1st to January 1st, and then they looked at January 2nd to January 2nd. So a pretty robust set of analysis they were looking at.
Right.
And over the rolling 1 year periods, markets were up 75% of the time. So that's a pretty high likelihood of success, but there's 25% chance that it's not going to be up in that period. So that's cause for concern. But when we look out over longer periods of time, so on the 1 year, it was 75% success. On a 3 year, 85% success. 5 year, 89% success. And on a 10 year, 95% success.
Wow.
As far as markets being up over those periods of time. So what that means is markets are really hard to predict in the short term. So when we're looking at short periods of time, the stock market is not that easy to predict. But when we extend the time horizon and we start to look at longer periods of time, the market becomes much more predictable. So when it comes to investing our money, again, we hear this all the time, you have to maintain a long-term perspective when we invest. So how does somebody that's entering retirement or retired, how do they keep a long-term perspective? And there are ways to do that. And we're going to get to some of those strategies when we get on to the end of the show here.
Yeah, no, this is so helpful to look at that data. And really what you're saying, if we had to sum this up, is that the longer your time horizon, the better chance you have for those positive returns. But again, that's the difference, right? When we're working and we're saving and we're putting away our hard-earned money, we have time on our side. But the closer we get to retirement, and then once we're there and we're not contributing anymore, now we also have to live off of that money.
Yes.
That's the challenge.
Yes, the utilization of those funds that we set by our lifetime saving, are now we're in the phase of our life where we're going to be utilizing those funds. So it does feel different. And the psychology that goes along with market fluctuations is really important because typically what we see is when we're making decisions in the midst of the downturn, consumers are generally making irrational decisions that aren't really in the best interest for their long-term success. So we have to have a process that we're making important investment decisions, not in these times of high volatility and uncertainty, but we have a plan in place for how we're going to deal with these market drawdowns when they happen.
Right, and there's hard psychological, emotional things to deal with that, right? I mean, that's the hard part, is staying the course when you are watching your money take these hits.
Yeah, and I don't want to minimize that because it is difficult to manage the emotions. And I think that's because there's the emotions around loss are magnified as compared to the emotions around gains.
Right, people want to avoid loss, right?
Yes.
As much as possible.
So losses feel a lot worse than gains feel good.
Exactly.
So again, we have to put ourselves in a position that we're making sound investment decisions, not when we're in that emotional turmoil. So that's part one of the psychological factors that play into this.
Right.
Obviously, the media stokes the fans the flame, and it's creating this fear. So I think it would probably benefit most of us if we could maybe tune out the media as we're going through some of these downturns.
Yeah, for sure, and stick to the facts, which is why this data is so helpful. But again, this is a huge part of your job for you as a financial advisor and the team of Citizen Advisory Group, is to help folks stay the course regardless of what the markets may or may not be doing out there. So what encouragement do you have for our viewers? How would you be able to help someone who's watching today who's feeling nervous about potential market downturns with their hard-earned money?
Well, it's exactly why we do the television show, and it's exactly why we offer the complimentary retirement checkpoint review, so that you can do an analysis with us of your investment portfolio and make sure that you have the allocation that is tailored to your individual goals and objectives, so that time can be on your side and you can maintain that long-term focus. So we're offering this retirement checkpoint review to go through the 5 areas of financial planning to make sure that you can stay on track for long-term success.
Kevin, thank you. I'm excited to dive more into all that entails for our viewers and in this important conversation. But if this is resonating with you, if you've been feeling nervous in light of what the markets have been doing recently, if you would like to be able to have a team on your side to help you stay the course and make the best decisions possible with your hard-earned money, the team of Citizen Advisory Group is here for you. So to claim your complimentary retirement checkpoint review, all you need to do is call that number on the bottom of your screen, 866-630-1675. Or if you'd rather connect online, you can simply scan that QR code and that will get you connected as well. We'll be back with more on how to navigate the storm of market drawdowns right after this.
As a youth, I spent my summer months on the construction sites with my family. I think I learned early on the value of hard work. Ultimately, though, I was led into the financial services world where I joined my brother Jeff.
You know, I think many people think that the financial piece is just so prevalent and the most important component, but there's just more to it than that. It's about the experiences, it's about the relationships, it's about the life that our clients are living.
They've got things set up so that the biggest decisions I have to make are whether to use a 9-iron or a pitching wedge, and what is my cocktail this evening.
It's our family coming together with your family. It's your financial pieces coming together to have a coordinated plan. It's our community coming together to keep that social connection.
I like the family atmosphere that they have. I think they treat everybody like they're part of the family of Citizen Advisory Group. I just love that they take care of us.
I think we pride ourselves on the comprehensive services that we offer, which starts with the holistic financial planning.
That retirement checkpoint view is going to be a full review across the areas of investments, your income, taxes, insurance, and your legacy and estate plan to make sure that you have a coordinated plan and it is tailored to you, the individual.
We build all of this together to get the most out of your retirement so that you can have the retirement that you've always dreamt of.
Welcome back to Retire Well. I'm your host, Kristen Oakley, here with Kevin Bucher, owner and financial advisor of Citizen Advisory Group. We're so glad you're joining us today. If you're just tuning in, we are talking about navigating the storm of market downturns. And in the first segment, we established that historically the markets have always come back. They recover. But we know that market volatility can often strike fear, and a lot of investors might be tempted to move to cash. I know you hear people talk about this. I have as well. However, we often hear that trying to time the market is a losing proposition, and we're going to share with you why that is. It just does not work, and there's lots of data to support why trying to jump in and jump back out can be devastating to your financial plan, right?
Yeah, so to do that, you really have to make two decisions correct. So the first decision is you have to make sure you're getting out of the market before the drop.
Right.
So you have to be right on that decision. And then just as importantly, you have to make sure you re-enter back into the market before it's recovered.
Right.
And so you have to be right 2 times, and history doesn't really support that there's a whole lot of success when people are trying to make that decision. So let's just go to some of the data around this, right? So looking at a JP Morgan study that was done in their asset management guide to the markets, when you're fully invested, so they looked at the period from 2000 to 2020, and if you were fully invested in the markets, again measured by the S&P 500, your annualized return for that 20-year period would be 7.5%. So I think that's a pretty realistic assumption about investment returns over a 20-year time horizon. So that would have required you stay fully invested for the whole 20-year period.
Right.
So they also ran that same study, and they said, what if you missed the 10 best days, just the 10 best days over 20 years, and that return gets cut more than in half.
Yes.
So instead of averaging 7.5%, you now have only averaged 3.4%.
That's huge. That's a huge difference. Just missing that best 10 days, and it cuts your returns in half.
In half.
Yeah.
And so let's put some dollars to that.
Okay.
So if I invested $10,000 and I average a 7% return, that money's going to double for me approximately every 10 years. So 10,000 would become 20, 20,000 would become 40 within this 20-year study that they looked at. So if I'm only getting half of the return of that, I would have not just missed I would have missed one of those doubles. So instead of my money going from 10 to 20 and then 20 to 40, my money only went from 10 to 20, a $20,000 difference just on a $10,000 investment. So again, if you're going to employ strategies where you're trying to time the market and get out of the markets and avoid downturns, you have to make two decisions correctly, and the research just doesn't support that is done with a very high probability of success.
Right.
Because just missing 10 days reduces the returns in half.
It's amazing when you look at that data. And to your point, you have to be right twice. Nobody has a crystal ball. If people did, everybody would be rich, right? But that's the problem. We don't know when those best performing days are going to occur. And often they occur right on the heels of some of the worst performing days. And the other thing I think it's interesting, as you know, I used to travel nationwide and present on this subject. And everyone wants to know how to buy low and sell high, right? That's the goal. Well, the problem is when people are looking to jump in and jump back out, they end up doing the exact opposite, because you end up selling low. Let's say you see the markets going down, you panic, you want to move to cash, for example. Well, now you've locked in that loss. And then typically when people are trying to jump back in, now they're buying high, right? It's the complete opposite of what it is you want to do.
Well, and that, to back that point up, research that was done by Bank of America in their global research report that was run in 2022, the worst days of the stock market, we typically see the best days occur within 14 days of those worst days. So you would have to, again, time the exit and re-entry so well, and there's usually not positive indicators before the market starts to recover. So again, it goes against the emotional behavior to properly do market timing, which is why making these decisions by having a comprehensive financial plan when we're not in periods of the market drawdown, so that you can make rational decisions that aren't part of all the emotional turmoil that comes with the drawdown, so that you have already made the decisions about how you are going to respond in your investment portfolio during these times of a drawdown, you will likely have much better results on the long term.
Yes, and I know we've got a lot of data that we're supporting and sharing today, because it's just helpful to see it in numbers, to see, okay, these are the facts, this is what happens. And I know that there's a lot of studies of actual investor behavior during market downturns, which shows that our human behavior doesn't match up with what we need to be doing often, right?
Yeah, so again, this was a very data-heavy show today, Kristen, but Dalbar does annual research on investor performance as compared to the overall markets. And what they found is that consumers that are working with an advisor who's doing comprehensive financial planning average about 4% higher returns over a 20-year period, and maybe just as importantly, over a 20-year period, 22% more income in their retirement. And I think that speaks to advisors helping consumers control their emotions and staying invested during these high volatility times, because time in the market has proven to be more important than market timing.
Absolutely, and that's so true. And again, it can't be stressed enough. It's not about timing the market, it's about time in the market. But yet we know that can be challenging when you are seeing the fluctuations. And this is why I think, one of the things I so appreciate about you and the entire team of Citizen Advisory Group is your commitment to education, but also to communication with your clients, helping them stay the course. You're the first to reach out when the market's going crazy to help folks understand what's happening and how they can navigate it successfully.
Yeah, and that really starts with this retirement checkpoint review process. We're offering a complimentary retirement checkpoint review for callers from today's show, but it's a process that we go through with our clients on a regular basis. And what it does, it allows them in these turmoil times or times of high volatility to go back to the basic and the fundamentals of their plan and really have some peace of mind and comfort. And that is what we're offering for callers from today's show, to walk through that process so that you can have that same peace of mind and comfort for your retirement.
Wonderful. Kevin, thank you so much. To our viewers at home, that number to call to claim your very own complimentary retirement checkpoint review is there for you on the bottom of your screen, 866-630-1675. Or again, you're welcome to scan that QR code and that will get you connected as well. Stay with us. When we come back, Kevin's going to be diving into some practical strategies to help you stay the course during turbulent times of market volatility. Stay with us.
Do you own an annuity? Are you aware of what type of annuity you own? For years, annuities have been considered a cornerstone of retirement planning, but they're not all created equal, and your current annuity might not be serving your retirement goals. The good news is, rising interest rates could mean better guarantees and better benefits for your annuity. If your annuity is not working for you, would you like to know sooner than later? Call now for your complimentary annuity review. Imagine not having to face your retirement with the same old corporate solutions as everyone else. In these economic times, you deserve a fresh perspective that includes a personalized retirement income plan, investment portfolio analysis, and tax map from an independent fiduciary advisor whose focus is on you. Call the number you see here to schedule your complimentary review right now.
Did you ever think that your own retirement would be shared with our government? It's true. Your 401k, IRA, pension, or similar retirement accounts are in partnership with Uncle Sam. Simply put, they want their tax dollars and you have them. With our latest tax calculator, you can plug in your own numbers while sitting right at home. To see what your tax liability to Uncle Sam projects to be, scan the QR code or go to mytaxbilltest.com.
Welcome back. You're watching Retire Well. I'm Kristen Oakley here with Kevin Bucher, and today we've been talking all about navigating the storm of market volatility and market drawdowns. We looked at the historical data. We've talked about why trying to time the market does not work. So it's time now to talk about some practical strategies to help you stay the course during turbulent times. So let's start with the structure of someone's portfolio, Kevin. How should investors structure their portfolios in order to better withstand market volatility?
Yeah, so again, this is the work that you ideally are doing when we're not in a period of a drawdown, and that you have the proper allocation for your investment portfolio that is for your goals and objectives based on your time horizon, your risk tolerance, and your financial capacity to take on risk. So when those things are properly constructed and you have the right allocation, well, we know that markets are going to go through up periods, we know they're going to go through down periods, but your investments are aligned to meet what your long-term goals are and your short-term goals, because we have to have some money allocated to the short-term solution as well. And I guess that's probably a good segue to talk about. We have to have short-term solutions for the utilization of the money that you need to support your lifestyle in the short term. And when we do that, we can put time back on your side, right? So a very consistent conversation that I have with people that I meet with is that are entering retirement, or maybe they're already retired, is that they don't have time to go through these downturns. And my argument to that would be that if we structure your portfolio properly, we will put time back on your side, because we know that when we invest in the market, we need time for that. But we need to make sure that we have your short-term needs being met by strategies that aren't subject to this market volatility. So when the plan is built properly, time is on your side to invest in the stock market. But just as importantly, when we go through these downturns, it creates some opportunities.
Right.
And we want to be positioned to take advantage of these opportunities as well.
And I think, too, a lot of the challenge of this is folks may have looked at this years ago or when they were working, but you and I both know that often investment strategies and allocations need to change and shift as folks enter and near retirement. So how should it change?
Yeah, so it really goes down to we need to make sure that we are using the right tools to meet your short-term income needs, so that you are getting the income you need to support your lifestyle from investments that are secured and structured and not subject to the day-to-day volatility of the stock market. Long story short, in other words, we want to reduce your reliance on the stock market's performance to meet your basic living needs.
Right.
And when we do that, we now can invest with that long-term perspective. We can go through the periods of volatility, and time is back on our side.
Right, but when you are not dependent on that to generate that income for yourself, that's the key, right?
Yes,
That can bring such peace of mind.
Yeah, you have to solve for your income,
yes,
especially as you're near or in retirement.
Right. Well, what are some other specific strategies that folks can employ during specific times of market drawdowns?
Yeah, it does create some opportunity to take advantage of some tax planning things. So for example, if I have a taxable account where I'm setting on some capital gains, well, I would have, maybe those gains have come backwards a little bit, and I might even have some of my investments that I have a loss. So looking at gain and loss harvesting strategies is really important in a down market. But it's also really important to look at a potential Roth conversion during these down markets. So if my IRA account balance has dropped because of a market downturn, that might be a really good time to convert some of that pre-taxed account over into a tax-free account while it's dropped in value, with the idea that markets will recover over time and that account's going to recover, but that recovery is now going to happen in a tax-free position. So taking advantage of taxes is important during these drawdowns.
For sure. We're making lemonade out of lemons, so to speak, right?
Yes.
But I know we have an awesome resource that we definitely want to highlight for our viewers, specifically regarding this tax planning.
Yeah, so we've created this tax calculator that really will do a projection of your long-term tax liability. If we just follow the rules that the IRS has set around the required minimum distributions for us while we're living, but then also for our heirs should they inherit that account. So the mytaxbilltest.com website will, there's 4 simple inputs that you put in, and it'll create a lifetime tax projection for you as far as what your liability will look like. And I can tell you from having many people go through this process, it's a shocking number as far as how much tax liability you have on those accounts.
Yes, and once you see the numbers side by side, you can't unsee that, and folks are often then even more motivated to take action, right?
Yeah, and you know, don't be surprised if the tax liability on the account that you're putting in the information on is greater than the current balance of the account. Because you not only owe taxes on the money that's in that account today, you are also going to owe taxes on all of the growth that happens in that account over what could potentially be 20, 30, 40 years of growth. So it's very common that we see that the tax liability is greater than the current balance.
Exactly, yep, and it's a huge eye-opening thing. And again, this is a completely complimentary resource, so we encourage you to visit mytaxbilltest.com. This time has flown. Kevin, any last words of advice that you want to offer our viewers regarding navigating these market drawdowns?
Yeah, retirement planning is a complex thing. There's so much that goes into financial planning. The Retirement Checkpoint Review is going to take a look at your investment strategy, your retirement strategy around income, your tax planning, your insurance, and your legacy and estate plan. So take advantage of this complimentary offer today.
Wonderful. Kevin, thank you so much. And to our viewers, thank you for joining us. Again, that number to call to claim your complimentary Retirement Checkpoint Review is 866-630-1675. We appreciate you being here. Be safe, be happy, be blessed, and we look forward to being back with you next time here on Retire Well.